Hey, good evening, everyone. This is Robert and Jason with Mr. Texas Real Estate. This is the Texas Real Estate Radio Network. Hey, thanks for joining us tonight. We appreciate you guys, as always, hanging out. Whether you're listening to us on the radio or a podcast, you're watching us record this live, we are certainly very appreciative of you spending some time with us.
Today is graduating from high school.
We're going to graduate from high school. Right, that's
This is real estate high school.
Yeah.
Graduating real estate high school.
So I'll set the table. We have some folks around us, and folks obviously out there on the internet, and gurus, and all those guys who are, they do the owner finance, the lease option, the sandwich wrap, all that stuff, and the first presumption is, hey, they have the money, they just don't have the credit. And I've heard every single guy, no matter what it is, whether we're doing a wrap, a lease option, all that stuff, is always in that conversation is, see, they have the money, Rob, they just don't have the credit. Some of them don't even don't have no credit, right? They don't have an established credit, but they want a house. Mm-hmm. And so we've put our brain to this a few times, and I guess more so over the last 72 hours or so.
Yeah.
And we started researching, and we know some adults in the mortgage world, mm-hmm. and we've had some conversations, and we figured a few things out, and it turns out, just like we always thought, it's not a good method to build wealth.
So let me kind of explain. When you look at, we're in the note business, right? So when you look at notes and buying and selling notes, whether it's doing a hard money loan or a refinance, that mm-hmm. sort of thing, who is the ultimate buyer of those notes?
Right.
And the ultimate end buyer is not really an investor. It's really not the end buyer. I'm talking about big institutional.
Oh, for sure.
But
yeah.
I'm not talking about you got a couple $100,000 in your Quest IRA.
Nope, they're a packaging company.
What those folks are doing is they're offsetting risk.
Mm-hmm.
They're invested in other assets that they have in their portfolio, and then they're offsetting their risk with these low yield but relatively safe investments.
Yes.
That's why when you look at the credit profiles of borrowers since 2009, 40% of them all have a credit score of 720 or higher.
Right.
Why? Because Wall Street, who ultimately packages and buys all these notes, needs them to be relatively low risk. They're 30-year fixed rate mortgages, right? They need to be relatively low risk. So when you really start to dig into the note world, it is a world of risk management.
Yes.
So a lot of the questions I've been asking, since we started working with Brian, I don't know when that was, probably a year or more now at this
sure.
point, right? Is how do we mitigate risk?
Mm-hmm.
We can raise all the money, we can find all the assets, but how is risk mitigated? What should we have in reserves, and what should we have in like a legal fund, and all
right.
that, all that sort of stuff. The reason you don't have these discussions when you're flipping houses or you're a landlord is you just don't have these liabilities.
No, it's a transient business.
Mm-hmm.
In and out. Yep.
Yeah, it's in and out and that sort of thing. So, in any case, we're having a lot of value at risk conversations right now. This is well above high school, by the way. We have definitely graduated high school here. So we're having a lot of what they call VAR. We're having a lot of VAR conversations. And what does that look like? What is that? If you equate it to single family real estate, what's your risk in single family rental properties? You can insure against a lot of risks.
Right.
The only risk you really can't insure of is a bad tenant or a bad, I shouldn't say a bad tenant, a poor performing tenant or a poor performing contractor. In other words, the contractor screws you. Yeah, you can sue the guy. Most of these guys don't have any money.
Right.
So you're not going to get anything out of them. And if you or your property management company selects a poor performing tenant, then you've got to get them out and fix it, that sort of thing. The note world's a little bit different. And we're learning that as we navigate some of these things that we're doing with the private mortgage lender group.
And we spoke to, specifically, you spoke to a group that originates and sells notes, and they say they never have more than 10 on their plate at any one time.
Yeah, I've talked to a dozen different
Yep.
operators in the last 3 weeks, and one of the fascinating discussion is these are like a hardcore note buying group out in Dallas, and they buy non-performing, they buy performing. They really like performing, so they sell these things. And I talked to the proprietor of the owner of this particular group, and I said, well, what do you hold personally? And they said, look, we really never hold more than about 10 because we've experienced 08, 09, and the challenge that she said is that how do you mitigate the risk?
Right.
How do you reduce the risk?
Right, because when it comes in a tsunami, right? Just all at once.
Right.
It's not a gradual raising of the tide, right? It's just it hits you and we're done.
Right.
So that was pretty interesting. That a person whose organization processes thousands only keeps 10 at a time.
Yeah, in their personal. Now, outside of that, in their business, they do keep a lot more notes, and so the question is always, how do you mitigate the risk of defaults and that sort of thing, and what do you do here? What do you do there? So we're having a lot of those kind of conversations because as we're helping grow some of these other businesses, that's the real question is, how big. This is a very interesting conversation. How big do you really want to get?
Right.
Because at some point you become so big you have to self-insure. And what does that look like? And as you're growing a business, the other conversation you have to have is with your lenders and banks. And you have to sit down with a bank and say, okay, here's what we're doing. And it's a little bit outside the box, but we're willing to take the risk. But here's how we can speak intelligently to the risks that we are incurring as we go about our daily business. And that's a very different conversation than if they were lending to somebody else and lending to a manufacturing company or a C-store or a hotel, and they can say, okay, well, this is how much we're making, this is what our expenses are, and this is what it's been like the last couple of years. What we're doing is quite novel in this space. And so you got to be able to create not only that business plan, but you also have to sit down and say, here's how we quantify the risks. Here's how we've done the math. You can let your analysts go do the math and see if this is an appropriate way to manage this risk for a new product class.
And yes, that's going to be a consequence of growing your business out, right? You're absolutely self-insuring. What's the pool look like? Who's going to back us? Where can we tap into? Who's the underwriter? All that stuff. All this stuff is real conversations you have if you're truly going to be getting into a business that is going to buy and sell notes, right? Mm-hmm. Like a real note buyer. And these guys, and again, we're not talking about, guys that do a few or hard money lenders who produce and sell the note out, right? That's a different little type of thing. We're talking about performing long-term notes.
Yeah, I mean, there's relatively little risk in notes that are 12 months or shorter.
Right.
Right, because you're in and out so fast.
Yep.
It provided you've done your due diligence correctly. We're going to teach a course at some point. Probably Brian and I both are going to teach a course on due diligence and how you do due diligence on the borrower and then on the asset as well.
And we're going to talk about a whole segment about analyzing the risk on your side of it when you're buying one of these things, because I think there's a misnomer in this marketplace. I think this marketplace has only been trained to do hard money notes. Well, that 12-month note.
I think you're right, and I think the real conversation we need to have is LTV versus DSCR, and we'll get to that here at some point.
Yeah,
but I think that in this marketplace and in a lot of the note business space is everyone looks at LTV. And I just read in a fantastic white paper that I pulled up Friday that blew that whole notion to bits. Right. In fact, the fascinating thing is so there's I had this conversation with a lender on, I was hanging out with three lenders on Friday. And one of the common misconceptions in the note space, in the mortgage space is, well, if they put more down, they're less risk. And I said, and then I'll say, okay, well, explain to me what that risk means, right? And he's like, well, this is how you recover in case. I said, it doesn't make the deal necessarily less risky. It ensures that you're able to retain more of your principal as a percentage of the deal.
We're going to come back from this break here because that was a really important conversation you had earlier last week. This is Robert and Jason with Mr. Texas Real Estate. This is the Texas Real Estate Radio Network.
Welcome back. Jason Bile with Robert Orfino, Texas Real Estate Radio Network. I'm already thinking about lunch, and we're only the second segment in. We're going to speed these segments up, hey, Rock? So in this marketplace, I hear this all the time from hard money lenders, private lenders, owner finance folks, bankers, mortgage people. And they'll say something like, well, if you have a higher percentage down payment, that there is a less risk of default. And I always thought, no, that's not necessarily true. Default risk and down payments are mutually exclusive. For example, I think if you sit down with any lender and say, hey, well, if a guy or a gal, let's say a guy's flipping a house and he's got an 820 credit score, but he doesn't have much cash, does that mean he's a higher or lower default risk if he was somebody with, let's say, a 600 credit score and could put 50% down?
Yeah.
And one of the things that you'll find when you really start digging into the credit analytics, when you really start digging into the collateral of the borrower, not collaterals in like the real estate and the cash, but in other words, the actual package of who the borrower is, I would much rather take a higher credit score individual because we know they pay their bills, even though they don't have as much cash, versus one that has more cash in the deal. And one of the, I've spent the last couple of weeks just mulling over all the data. One of the things we found fascinating is percent down payment doesn't ensure, does not reduce your default risk.
Yep.
And I see this at, where I see this, the biggest mistakes is with the private mortgage lenders, right? The private guys will say something like that. They completely miss the boat. They completely screw this up. I know because we've had to take them out of deals before, right? They'll say something like this. I've got a new flipper, not much experience. They got a little bit of cash, but not as much as I'd like to see. And I'm going to, since they are higher risk, I'm going to charge them more points and more interest. And I look at them and say, that's ridiculous. Like, you realize why that doesn't work, right?
Right.
Well, so I'll give you the extreme example. Let's say there's a crackhead on the corner over here and they want to borrow $100.
Yeah, probably meth.
Meth. Oh, yeah. So we're on this side of town. So it's meth over here, right?
Mm-hmm.
And they want to borrow $100. And so you go, you know what? You're higher risk because you're on meth. I'm going to give you $100, but I'm going to charge you 2 points and 14% instead of
5 and 15.
I'm going to charge you 5 points and 15%.
Sure.
Usury. I'm going to charge you 5 points and 15%.
Yep.
And they go, oh, okay. And they take the money and run and you never see them again.
Yep.
Well, what happened? Well, Jason, they were a higher risk borrower because they were meth head. And I just told them that they'd be charged more points and more interest because they're a meth head. But I'm like, yeah, but they just ran off with your principal and they're never going to pay you back.
Right.
So the idea that you'll hear this misapplied, higher risk, higher reward. I'm like, that's not how that really works.
Well, but depending what world we're in, if you're selling that note in less than 30 days, who cares?
Oh, absolutely.
Right? So that's the problem is you start getting this crap paper that gets pushed around and advertised as this great investment opportunity.
Yeah, it's this great so we get the paper all the time, right? We see the in particular, I don't know what brand, I don't know what kind of note person you would call this. Let's call it a private mortgage, where the house is worth $60,000. They create a note for $100,000. They take $20,000 down, and then they'll tell me, well, Jason, this is a good note because they put 20% down.
Yeah.
And I'm like, yeah, but they put 20% down on an asset that's only worth $60,000. They're $20,000 underwater. And just because they put $20,000 down doesn't mean that the default risk has decreased.
Right. So let me
By the way, this whole study is called psychological accounting or psychological finance. You can Google it up. It's very fascinating.
So we have this world where you might be at a RIA club and you might hear, hey, this is a great way to do it. If the house is worth 60, well, you don't have to do an appraisal. You can just, inflate it a little bit because, hey, you're going to do a little work and maybe you think it's worth 100. Okay? So we're going to sell it at 100. They're going to put 20% down, which is $20,000, and they're going to pay off $80,000 loan, which shouldn't be a problem, right? Again,
right.
It's 6%. You're talking about maybe $700, $800 a month PITI, right? So that's, and you think, hey, you can afford it. And why we know people that ran out and did that model to the tune of 100 doors.
Yeah.
And the problem is your paper is worthless.
We know a ton of owner finance guys that have a lot of these in Houston.
Yep.
And they've actually started posting on Facebook. They're looking for a bank to buy their paper because the bank looks at it and says, you're 125% collateralized. Why would we buy this paper?
And the issue becomes the difference between, again, us and that model is we're the landlord. So we're the mortgage holder, right? We're
the borrower.
Yeah, we're the borrower. In a lot of those scenarios, they put that tenant, right? So then we have to go to that part 2. This is what we're talking about, the risk. That tenant that, again, he has $20,000 cash, but he doesn't have a FICO score or a worthy FICO score, or he can't prove he's a nationalized citizen, right? He can't.
Or where's the income come from?
Right. There's no income verification. A whole bunch of things. We just want to grab the 20, right? And I've seen these guys stand on the stage. It's a goose that lays a golden egg. You just keep doing it over and over and over, and it's just like, wow, you
just keep fleecing these poor people.
You're fleecing the poor people, and you're just creating D paper.
That's right.
Right.
And then you can't exit.
And then you can't exit. Yeah.
Unless you get a private.
You exit by finding another sucker who comes along and wants to do it, right?
That wants to do that paper, right?
It's Bitcoin of the real estate world, right?
That's right.
Just find someone else to pay for it. Yep. Get lucky. You get 3 years of good cash flow. You package it up. I'm selling a 10-house package.
Yeah, who wants it? I get that all day long. The 10-house package of these great notes.
So that becomes the issue. Now, I'm sure there's a way to make money out there to do that, but this is what we're talking about, and the theme today is graduating high school, moving to college, is the note you're trying to sell me, okay? The note you're trying to sell me, why can't you just go to a guy on Wall Street and sell that note?
Right.
And the answer is they wouldn't give you the time of day. So why would you sell me your junk paper?
That's right.
Right? Because I don't know any better is the answer. Hey, this is Robert Jason. This is the Texas Real Estate Radio Network. Thanks again for listening. We're going to be back here for another half hour. Hang tight, and we'll be back. Thanks. Hey, guys. Robert here with Mr. Texas Real Estate. I'm joined by Jason Bible, my partner. This is the Texas Real Estate Radio Network. Hey, guys, if you want to check us out, go to our website at mrtxre.com. MR is in Mr. TX is in Texas. RE is in realestate.com. That's mrtxre.com. If you have something urgent or you want to talk about our fund or you want to talk about the mastermind, then you're going to go ahead and text us. Text only 281-401-9008, 281-401-9008. So it looks like so far in the first 10 days of January, we've got 4 new mastermind folks.
Great.
I got 2 more verbal commitments I got to convert, and then 2 came in already this weekend.
Oops. I sent an email out and said we had 4 spots left.
No, there's only 2. I saw that email go out. Yeah, I just hadn't collected yet.
That's all right. So let's talk a little bit about the note business because we're selling notes right now. And the fascinating discussion we've had with these note buyers is what's the LTV and what's the rate? Right. And I keep looking at them like, those aren't the right questions.
No.
That's not the right question at all. LTV doesn't matter, neither does the rate. The question you should be asking is, what is the DSCR? What is the debt service coverage ratio?
Yes, for landlord mortgages.
Correct.
Right?
Correct.
Yes, absolutely. You should be looking at the DSCR. Now, you're going to look at the value of the property. You're going to make sure, hey, can I sell it? Can I get out of this thing? Great. What's the debt? But what is the debt service coverage ratio? And again, so we know that when we put this thing out and we say, hey, we have some notes, or we talk to people or whatever, we can tell right away where they've been trained, right?
Yeah, I can tell you exactly what real estate clubs. This is everything for like the last 7 or 8 years. I can tell within the first 2 minutes, based off the kind of questions and terms people use, what real estate guru they're a part of.
And if you're asking about LTV, that is a very realistic and practical question to ask, and LTV is going to be on our flips.
Yeah.
If we're flipping into the hold situation, then yes, you should be asking about the LTV. You should be asking about what the exit is. You should be doing all that stuff. I'm assuming that the people that are lending to us have faith in us, know that we're here. Obviously, we have a big building with our name on the side, so it adds a little bit of credibility. But I would also tell you that, hey, if you're going to invest in some of these new folks and lend to the new folks, you should figure out who you're lending to. So if you're the landlord like we are, or the owner of the house, that's great. My problem becomes is when you're selling this paper, and here's really what happens on some of these wraps, is they've taken A paper and made it D paper.
That's exactly what's happening.
So you had a qualified mortgage holder, and you've convinced them to do owner financing, and then you wrap it into this other guy who doesn't have any of the credentials, and you've taken A paper down to D, F, G. I mean,
yeah. So let's talk about what that looks like. Yeah. It's really sub 2, right? Subject 2. So you get a homeowner that wants to sell this house, and they need whatever it is the number they need, right? And you say, well, why don't you just sell it to me subject to the original mortgage? Original mortgage is $100,000. It's 3% interest. They had to qualify for the mortgage and get the mortgage. So then you as the investor are then going to owner finance that property to another borrower.
Sure.
But that borrower, that paper you're going to create, because that borrower you're talking to can't get a traditional mortgage.
Right.
They don't have the credit score. They don't have.
Correct.
May not even have the cash, but they certainly don't have the. They certainly don't have the borrower profile.
Right.
To get that loan in their name, right? So now they're going to create a note, and maybe they wrap it for a little bit more. Maybe it's like $120,000.
$120,000 and 6%.
Yeah, 6%. So they're going to make 3% on the spread.
They're probably charging 2 points origination.
Right. So even if that property appraises, you're going to take this note, and now what do you do with it? Well, Jason, you'll hear this all the time. I just created money out of thin air. I'm like, that is technically true.
Sure.
You also created risk out of thin air.
Yeah, a lot more risk.
But what's fascinating is I
only see the money balloon.
They don't see the risk.
They never see the big red balloon that says risk in bold black letters on it. They don't see that balloon.
It's amazing to me.
Just the green balloon.
Just the green balloon, right? Yep. So then I always ask, okay, well, what's the risk that you just incurred here? You may have signed a personal guarantee with the subject to guy. So if they default, the end buyer defaults, tears the property up. Now you're responsible for getting it rehabbed and putting it back on the market. And oh, guess what? They're just went your 20% down and any cash flow you experienced over the last year.
Yeah, but I mean, even if you just run it through a perfect scenario, right? They're going to stay in for 4 years and then they're going to leave. You still have that risk that it is, and we know because you can see the charts out there. There's real data here that shows who's going to default on the loan.
Right.
And some of these guys, some of the classifications that you're doing a wrap with or a lease option with, these people have a 40% chance to default on their mortgage.
Right.
And you're really dealing with the risky of the risky pools, right? Mm-hmm. And so, again, and all we're saying today is we know people who do this. We know people who built a big model on this. We know people who are collecting big fat checks every month on this. Mm-hmm. However, going all the way back to the original segment, to the husband and wife team who say, we never carry more than 10 ourselves.
Yeah.
Because when it comes in a tsunami and takes everything out. Mm-hmm. And we don't want to be exposed more than 10. So one of the things you're gonna recognize when you're moving from high school into college is that your first forethought now is risk.
Yeah, let's put a nice bow on this one.
Yep.
If you're going to a real estate seminar and the seminar or class or whatever it is you're going to talks about cash flow and how much you need out of pocket, and this is how much money you're going to make, that is elementary school stuff.
Yep.
Like my kids can do that math. The real discussion after that initial discussion on how do you buy these things, how do you finance them, the next discussion needs to be on risk management. Okay, how do we keep from losing money?
Right.
Especially in the note world, as we're bringing folks in and we're selling our notes, the first conversation I have with these folks is, this is how you can lose money. In fact, it's the first conversation we have on our syndications. Mm-hmm. It's the first conversation we have on our fund. It's the first conversation we have people when they join our mastermind and they want to buy real estate. I'm like, let's talk about what puts your real wealth at risk. Everybody thinks it's getting sued and that sort of thing. It's not. That happens very rarely.
We need a land trust to protect ourselves.
Yeah, it's all that land trust, LLC nonsense. Like being sued in real estate it happens. We get sued because of the deal volume we do, but it's actually relatively rare for the small time kind of landlord, note buyer, that sort of thing.
No, you're going to skip through a lot of this stuff. Yeah. Yep.
So one of the things that I'm finding fascinating, because we're tied in with a lot of the note world here, is how little notes are being traded in Texas, which I thought was interesting. So the question is why? Well, there's much less risk in Texas notes because it's so much easier to foreclose. That's one of the reasons. Now, that doesn't mean that just because it's easy to foreclose, they're less risky than they are in Florida. But when you start moving along your investment career, you start worrying a lot less about rates of return, cash on cash, that sort of thing. And you start looking at, okay, where's the risk at? What am I missing here? And I'll never forget every single guy that I've ever met with that's really, really wealthy, because all of them have told me this exact same thing. Jason, you're going to spend a lifetime building this thing, but you're going to work 10 times harder to keep it.
Right.
And they all say that. They're like, you think you're working and using your brain in overtime now, you will spend more time figuring out how to keep it, how to defend against those attacks, right? So to go back to the note scenario, where can you mitigate risk in notes? And just like in any asset class, you just pay less for it.
Yeah.
However, you still have a substantial amount of principal at risk. And a note at the end of the day is a derivative of a piece of real estate. It's not real estate. A lot of people think that. It's not real estate. Kind of like apartments are not real estate, they're a business. That's usually a shocker to folks. Like, what do you mean it's not real estate? It's not a real, this building right here is not real estate. We call it real estate, but it's a business, right?
Sure. Yep.
So the reality is that you really start having these risk management discussions on, okay, what if it goes bad? How do we get back at the asset? How do we take this thing back? What is, where are the other pitfalls or hurdles that we could run into as we're buying these notes, whether they're commercial or residential?
We're going to continue on with this when we come back from the break. This is Robert and Jason, Texas Real Estate Radio Network. Hey, welcome back, everyone. This is Robert with Mr. Texas Real Estate. I'm joined by Jason Bible, my partner. This is the Texas Real Estate Radio Network. Again, if you guys want to check out our website, mrtxre.com. MR is in Mr. TX is in Texas. RE is in realestate.com, mrtxre.com. And we should have a new version coming up here in the next 7 to 10 days. So we're very excited about that. And we're just talking about, the difference between running, 5, 20, 50 deals a year and trying to step it up to 100 deals and looking at across the board and where do the pivots happen? We've talked about it on labor. Right away you're going to need some middle management. You're going to need some reporting systems. You're going to need other systems. But from day one that we look at all the time, it's the number one thing we look at every deal. Mm-hmm. What's the risk and how do we mitigate it? And again, so I think, and we have an eye on, hey, we're not just going to be a 50-house operator.
Oh, yeah, absolutely.
Right.
Not.
Hey, we're not just going to have a $25 million portfolio. We're going to blow this thing up. And if we're going to blow it up, we're going to college. And how do the big boys play? And one of the things that we absolutely have determined and kind of knew but got verification on in the last 7 days is nobody is messing with that D grade paper.
Yeah, it's and let's back up when we talk about D grade. We're really talking about non-QM.
Just go through the FICO scores real quick.
Yeah,
so A is
720 plus, right? Yep. B is 580 to
650, right?
650 to about.
Yep.
And then
the CD is up to 580, up to 550, up to 650.
Right. So we started having this conversation about, because we've got these non-QM lenders, right? And they're doing all kinds of stuff with us. And so one of the conversations that we've had with lenders is, what do they do with this non-QM? So let's talk about what non-QM is. I call it commercial mortgages. And really, it's commercial mortgages for homeowners, for real estate investors like us. And the question I keep asking is, should we be in that business? Right? Should we be in the 15, 20, 30-year business? So I started researching a handful of companies. Some of them are selling their bonds. They're just now getting to the point where they're big enough to sell their bonds. So I'm sitting there and I'm looking at the marketplace, and I'm like, all right, so I need to reach out. I have some buddies that used to work on Wall Street that did nothing but mortgages right before the crash. And the question is, there's nothing sexy at the end of the day about a 5-6% note. There's just not. It's not Uber.
No, I get it. But
it's not Airbnb's IPO.
Yeah, but it's bread and butter, right?
But it's a little 5-6%.
Sure.
Just every single day, just getting your check, so the money's coming in. And so the question you've always got is, well, who's interested in that paper? And really, it's institutional investors that are looking to reduce their risk.
Yes.
It's insurance companies.
Of course, insurance companies. They're the big daddies, right?
So the question you then start asking is, okay, so how do we build a portfolio of commercial paper?
Yeah, commercial ready, yep.
Which is residential and commercial.
Yep.
And how do we sell that in such a way that meets the risk profile of these end investors?
Sure. And those guys will typically buy some of our stuff between 6 and 8%.
Yes.
And again, just so you understand, what we're looking at is we're looking across the market here, and we have a list of investors who are asking for 10 and 12 and 14 and 15%. And we're like, wait a minute, we're producing really good paper.
Great paper.
We're really producing very good paper. And again, we're the landlords. And we're offering PGs for some folks. And so we've got a really good grade of paper here that we shouldn't have to put out for, more than 8%.
Right.
And so we start looking back at the marketplace saying, well, where is this coming from? And then we realize that, oh, hey, there's a lot of guys out there just producing crap paper.
Yeah, just to get the interest rate, right?
Just to get some cash coming. And then there's some people in our marketplace that are teaching people basically about flips and not long-term holds.
Right.
And so one of the things we said was, someone asked LTV, and we're looking at that question on when it comes back, when the email comes back and says, well, what's the LTV? We're like, that's not the question you should be asking. I know it's a question you're asking, and I know why you're asking it, but the real question you should be asking is
what's the DSCR?
Right.
What is, and a better way to say this is, what is the asset's ability to pay?
Exactly.
That's really the question you should be asking. It's, what is the asset's ability to pay? So we're buying I got this guy who sent this. Now, you know what? Let's talk about what really kicked this off. I got a really nasty email from somebody about 2.5, 3 weeks ago.
Hey, dummy.
Yeah. He's like, hey, you must think I'm stupid. I almost replied back, I've only done 1,000 of these.
Yeah.
I mean, maybe you could teach me something here. I'm always willing to learn. But anyway, so he said, you must think I'm stupid if I'm going to take on something with such a high LTV.
Right.
And my comment was, well, the reality is that we're just having a radio show here. It's no big deal.
Yeah.
The property we're buying is in a rapidly appreciating market.
Yep.
We're buying it it's got maybe 10% equity in it. It's not a whole lot.
Yeah,
But,
10, 15%.
Yeah, 10, 15% equity. But the DSCR, the ability for the property to repay, is like
2.23.
2.23.
Right.
Meaning the property produces so much cash
Yes.
that it's going to cover
Yes.
the lender, taxes, insurance, the whole shoot match by 2.23 times.
Along with our PG.
Oh, and we're
going
to PG it too.
Yep.
And the guy comes back to me. He goes, "You must think I'm crazy. I'm going to do this." And
He said, go find someone stupid.
I said, "Okay,
Yeah.
I'll go find somebody that can look at this asset and say, whether Robert and Jason are here or not, this property is going to produce 2.2 times the revenue to cover me, insurance, taxes, HOA, everything."
Yep.
And I'm like, "What is that? You guys keep asking the wrong questions."
And it's, again, because we know where they got, we have a good understanding when they start asking the questions where they were trained on their due diligence, right?
Yeah.
And some of it's legit. Some of it is absolutely, they should be asking some of these things. There should be equity in properties for sure, right? Mm-hmm. Who am I lending to, right? They should know who you and I are. They should know that, hey, we're going to give a PG on this stuff. And, but that all tweaks the rate, right? And so, and then the asset, what does the asset actually produce? And again, some of these properties out there, at a 1
Yeah.
DSCR, when you're doing these wraps and stuff, it's at a 1. It's like, again, what we're putting out there and asking for help from folks from our network, from the folks we've already verified are accredited investors or sophisticated investors, is, hey, look at all the data and make a decision here.
Yeah.
Yep.
But the problem is that most people just ask enough questions to satisfy what they've been taught in the class and I'm like, okay, well, let's get an entire risk profile set up for this borrower and this asset.
Yep.
How much does it cash flow? How much is insurance? And, it's all those sorts of things.
There's only 30 seconds left, so.
I know. It's funny. We can hear all our guys talking upstairs because the heater, I think it's because I left this door open again, and it's like 900 degrees in the studio, so we have all the doors open. But anyways, when you begin to graduate from high school, real estate high school, you start asking the question, well, how much risk am I taking on by doing these certain things? Where is the downside? Where am I going to lose money?
Yeah.
And it's been fascinating for the last couple of weeks as we've been selling our notes off, the questions people have been asking. And what it's made me realize is, oh, there's a whole nother business here, because the way the questions are being answered is not, it's not the right questions to be asking.
Right.
And so it's just started a whole new business venture. I'm just playing with it right now. It's very interesting.
Hey, guys, thanks for joining us tonight. We'll be back again tomorrow night.